All right, folks, let's talk about the cost of capital. Now, I know what you're thinking. Trevor, finance on a Monday? You trying to put me to sleep? But hold on, because this is actually pretty interesting. And by interesting, I mean it's about money. Think of it like dating. But instead of looking for a partner, businesses are looking for cash. And just like in the dating world, there's a cost involved. Sometimes you gotta shell out for fancy dinners or movie tickets. In the business world, that cost is called the cost of capital. Basically, it's the price a company pays to borrow money or use its own funds to finance projects. It's like a financial Tinder subscription, but hopefully with a higher success rate. Think of it like this. Now, you might be wondering, why should businesses even care about this cost of capital thing? Well, imagine you're opening a lemonade stand. You need money for lemons, sugar, maybe a cool sign that says, "Trevor's Tasty Lemonade." You could use your own savings or borrow from your buddy. Each option has a cost. If you use your savings, you're missing out on potential investment returns. If you borrow, you'll have to pay interest. That, my friends, is the cost of capital. Businesses need to figure out if the lemonade stand, or their big business idea, will bring in enough profit to cover those costs and then some. Otherwise, it's like dating someone who always forgets their wallet. Not a good look. So, how do businesses get their hands on this capital stuff anyway? It's a crucial question for any company looking to grow or sustain its operations. They've got two main options: debt and equity financing. Each comes with its own set of rules, benefits, and drawbacks. Think of it like choosing between renting an apartment or buying a house. Both have their unique advantages and challenges. Debt financing is like renting. You get the immediate benefit of using the money, but you don't own it. You're borrowing money from someone else, a bank, an investor, and paying them back with interest. This means regular payments that can affect your cash flow. It's like that friend who's always good for a loan but reminds you about it every time you hang out. It can be a bit of a hassle, but it's a quick way to get the funds you need. Equity financing, on the other hand, is like buying a house. You invest more upfront, but you gain ownership. You're selling a piece of your business, shares, in exchange for cash. This means you don't have to worry about monthly repayments. It's like having a roommate who chips in for rent, but they also get a say in how the place is decorated. They become part owners and have a voice in decisions. Each option has its pros and cons, and the best choice depends on the business and its financial goals. It's essential to weigh these carefully to make the right decision for your company's future. Now hold on to your hats, folks, because we're about to get fancy. We're talking about WACC, weighted average cost of capital. Don't worry, it's not as complicated as it sounds. Remember those debt and equity options we talked about? Well, most businesses use a mix of both. WACC is like a financial cocktail that blends those costs together to give businesses an overall picture of how much it costs them to raise money. It's a key ingredient in making big financial decisions, like whether to invest in a new project or acquire another company. If the potential return on an investment is higher than the WACC, it's like finding a $20 bill on the ground. A good day. Section 5. Industry Face-Off. Who's got the highest cost of capital? Now for some industry drama. Just like some dates are more expensive than others, looking at you, Michelin star restaurants, some industries naturally have higher costs of capital than others. Think about industries like tech or pharmaceuticals. They're constantly innovating and developing new products, which requires a lot of upfront investment. That means they often have higher costs of capital. On the other hand, industries like utilities or consumer staples tend to be more stable and have lower costs of capital. It's like the difference between dating a struggling artist and a Wall Street banker. One might be more exciting, but the other one probably has a better credit score. Section 6. Real-world examples, from lemonade stands to tech giants. Let's bring this cost of capital thing to life with some real-world examples, shall we? Remember that lemonade stand? Let's say you wanted to expand and open a whole chain of lemonade stands. You'd need more supplies, more locations, and more staff. You'd need a lot more capital, right? This is where understanding the cost of capital becomes crucial. You could take out loans, debt financing, which means borrowing money that you'll need to pay back with interest. Or you could sell shares of your lemonade empire, equity financing, giving investors a piece of your business in exchange for capital. Now, imagine you're a tech giant like Apple. The stakes are much higher and the scale is enormous. You're constantly developing new iPhones, Macs, and other innovative products. And those fancy AirPods that magically disappear into the void. Each new product requires significant investment. That requires massive investments in research and development, which is a long-term commitment. Apple uses a mix of debt and equity financing to fund these endeavors, balancing the pros and cons of each method. They carefully consider their cost of capital along the way, ensuring they make the best financial decisions. See? Cost of capital is everywhere. It's the financial backbone of every business decision. It's the financial force behind those businesses we interact with every day, driving growth and innovation. Section 7. The cost of capital and your investment portfolio. Now you might be thinking, Trevor, this is all very interesting, but I'm not a Fortune 500 company. Why should I care about the cost of capital? Well, my friend, understanding this concept can actually make you a savvier investor. When you invest in a company's stock, you're essentially betting on its future success. A company with a high cost of capital needs to generate higher returns to be profitable. That means there's more risk involved for investors. So, next time you're thinking about investing in a company, do your research and consider its cost of capital. It's like checking someone's credit score before you lend them money. Always a good idea. Section 8. Making sense of financial jargon. It's not rocket science. Let's be real, the world of finance loves its jargon. It's enough to make your head spin. But here's the thing. You don't need to be a financial whiz to understand the basics. When you break it down, the cost of capital is simply the price of doing business. It's about understanding the trade-offs between different financing options and making smart decisions that will benefit the business and hopefully your wallet in the long run. So don't be afraid to ask questions, do your research, and remember that knowledge is power. Section 9, Key Takeaways, Cost of Capital in a nutshell. Let's dive into the essentials. All right, folks, let's recap what we've learned today. It's been a journey through the financial landscape. Cost of capital is the cost of getting cash for a business. It's like the price tag for funding your operations and growth. Like finding a date, it's all about weighing your options. You need to consider what's best for your business. Debt and equity are the two main dishes on the financing menu. Debt is like borrowing a friend's car, while equity is like sharing your own. One involves borrowing, the other involves sharing ownership. Choose wisely. Each has its own pros and cons. WACC is the financial cocktail that mixes those financing costs. It's a blend of debt and equity costs. It helps businesses make informed investment decisions. Bottoms up. Cheers to smart financial planning. Different industries have different costs of capital. What works for one might not work for another. Tech companies and lemonade stands, it's a financial jungle out there. Each has unique challenges and opportunities. Understanding the cost of capital is crucial for businesses and investors alike. It's the cornerstone of financial strategy. It's a fundamental concept that can help you make smarter financial decisions and hopefully avoid any financial faux pas. Knowledge is power. And on that note, I'm out of here. Remember, always keep learning and stay financially savvy. Catch you on the flip side. Until next time, take care and keep crunching those numbers.